Welcome to Trading Master 101. Stock trading for beginners. Have you ever wondered how stock market traders work? You must already know that they make huge amounts of money. But how do they make such huge profits? The answer is pretty simple. It's not easy. Everything good takes learning, hard work, patience, and a lot of practice to develop. The important question is, can you learn to be a professional, full-time or part-time trader? Can you make consistent profits on the financial markets? The answer is yes, you can. It is a long journey, but I'm going to be there with you to help you from beginning to end. It all begins with learning to read charts. This is a basic candlestick chart. A trader sees a beautiful and elegant story within. He uses this story to get this. This is because traders are able to read charts, and most of the time they can predict what exactly is about to happen. And this is exactly what we're going to be doing in this course. This course is a basic entry-level course, and it's meant for those who have absolutely no knowledge on trading. Anyone can learn. There are no prerequisites for this course. It's not going to be a fast-paced course. You can view the videos as many times as you want, and you can ask me as many questions as you want. In this course, we're going to do what are Japanese candlesticks. We're going to learn how to read them. We're going to try and understand them. We're going to create some of these candlesticks. We're going to play around with them. And then we're also going to see some of the common candlesticks that you see on a candlestick chart. We'll do some common candlestick patterns. And if you don't know what candlesticks are, well, these are what candlesticks are all about. A bunch of candlesticks make up a candlestick chart. Each candlestick has a time frame, and we're going to learn how to select the best time frames for our trading. We're going to learn what is support and resistance, and then we're going to learn how to identify the key levels of support and key levels of resistance, and this is going to guide us when to buy and when to sell. And I'm going to guide you on how to take your skills to the next level. Welcome to the world of Japanese candlesticks. Trying to make sense of so many moving numbers is incredibly difficult for a beginner. It's also not a very clever move for most advanced traders. So, let's try to analyze one constantly changing number at a time. That's going to make it a little easier, but then we'll also use an example to do this. Let's say that the stock price of Apple is $50 when the market opens. Thereafter, the market is going to push the price upwards and downwards, and all throughout the day the price is going to keep changing. So a little while later, stock price increases by $1. It was originally trading at 50, but now after the increase, stock price reaches 51. So it's trading at 51 at the moment. A little point later in the day, it decreases by $1, and so it's trading at $50. It decreases again by $1, so stock price reaches 49. Decreases again by $2, and so it reaches, the stock price is trading at 47. Decreases again by $1, and so it's trading at 46. And then there's this increase, a huge increase by $6, so the stock price jumps up from 46 all the way, goes to 52. We have a decrease of $3, so it goes back down to 49. We have an increase by $5, so the stock price reaches 54. And then there is a decrease by $1. The stock price reaches 53, and this is where the market ends up closing. So the opening price is 50, and then there is this huge volatility. It goes up, it goes down, but at the end of the day, it closes at 53. Now I'm sure that looking at the way the prices have gone up and down, it is pretty difficult to find any kind of pattern given the way that prices have been moving. Therefore, it's going to be even harder for anyone to predict what is going to happen next. Japanese traders came up with a way to represent these prices in the form of candlesticks and candlestick charts. Candlestick charts make it easier for us to analyze price movements and detect patterns. This makes it easier to predict future price movements. So let's jump right in and see how candlesticks are made. The letter O stands for open, and it refers to the opening price for any specific time period. The letter H stands for high and refers to the highest possible price that any kind of commodity or stock reaches during that time period. The L stands for the lowest possible price during that time period, and the C stands for the closing price for a specific time period. Now I'm going to refer to this as the OHLC in the future instead of saying open, high, low and close. This is critical to understanding how to make or read candlestick charts, because candlesticks are made based out of the open, high, low and close. All candlesticks must have an open, high, low and close, which is basically in the OHLC. So let's jump back into our example and try to figure out the OHLC values, after which we will be able to make a candlestick for the specific time period of our example. So the stock price of Apple computers is $50 when the market opens. This directly means that O equals $50. Now price can go up, it can go down. Since the market opened at $50, O is always going to be fixed at $50. So after the market is open, there are going to be a number of fluctuations in prices. So let's say the stock price reaches 51, and this is what we've done just a few minutes earlier. The opening price, you'll notice, is going to remain the same. We're going to say O equals 50, and now the stock price reaches 51, which means that there has been an increase of 1. So the closing price is always going to be the last price that is being traded. The closing price is denoted by the C, so C equals 51, and during this time period we only have two figures here. We have 50 and we have 51, so the highest possible price that this stock has gone up to during this time period is 51. Therefore H is 51, and the low is the same as the opening price of 50. So don't worry too much about this. Once we go through a number of examples, you'll see exactly how to change the OHLC values. Let's take the next one. Stock price decreases by $1. So what happens here is that the current price, right, is 50 because it went down by $1. The closing price should now be 50. That's why it's being reflected here. Remember that the opening price is coming directly from there. It's not going to change. So all of these values are going to remain the same for the opening price. Now the high for both of this time frame or this time period has been 51. So H is going to be 51, L is going to be 50. Let's take the next one. Price decreases by another $1. So opening price is 50, the closing is now 49 because it's gone down by another dollar. The high is going to remain the same. The highest possible price, the highest possible number that we have is 51. It hasn't gone up to 52, right? Or it hasn't gone up to 54 or 5. When it breaks through this level, right, so the high is going to change. Otherwise, the high is going to remain the same. But we do see that the L, the lowest price, is 49. This is because the closing price goes down from 50 to 49. So the lowest number that we have is 49. That's what the L stands for. Let's do another one. Stock price decreases by a further $2, right? So the opening price is again 50. The high is going to remain the same at 51. The closing is at 47 because it goes down by 2. So 49 minus 2 is 47, and the lowest possible price is again changing and is becoming 47. Stock price decreases by $1. Opening price remains the same at 50, high remains the same at 51, but the closing and the low both become 46. Now price increases by 6. So when it increases by 6, the opening price is going to remain the same at 50. The closing price just goes up by 6. So 46 plus 6 is 52. The closing price is 52 here. The low is not going to change. It's going to remain the same because it hasn't gone down to 45. This is the lowest price during this time period. However, since the close is now at 52, and the previous high that we had was 51, right? So we can't put the high as 51 here. The high during this time period is 52, okay? Stock price decreases by $3. So the opening is 50, the high is 52, the low is 46, and the closing price goes down to 49. Increases by $5. So what happens here is that from the 49 we just go up 5, which gives us a closing price of 54. This 54 is higher than all of the other numbers that we have here, so the high is going to change to 54 and the low is going to remain at 46. And now it decreases by $1. So what happens here is that the closing price goes down to 53. The low, the high, and the opening price remain the same. So if you remember that in the previous example as well, the closing price was 53. You can pause the video and go back, and just to confirm, maybe you could even go through this example a couple of times so that you get the hang of how these numbers are changing and how the OHLC values are being obtained, because these values are going to show us how to create the candle that we're going to use to predict how prices are going to move. So this is very important for you to understand. Before we go any further, what I want you to note is that this last OHLC values that we have give us the opening price, the high, the low, and the closing price for a specific time period. Assuming that we were looking at the daily time frame, which means that the market opens in the morning at $50 and it closes at $53, these are the values that give us the entire summary of what has been happening during that time period. So we're going to use these OHLC values to proceed further and create a candlestick. Notice that the opening price is $50 and the closing price is $53. So we automatically know that the price has gone up. Let's say that the opening price is 50 and we can mark it right here. The closing price has to be slightly larger and will be placed above. If the closing price is right about here, the difference between these two is called the body. This is the body of the candlestick. And since price has gone up, we're going to color it in green. And then we can go ahead and place in the high and the low. So the high is 54 and we can draw a line upwards from the body, and for the low we have to draw a line downwards towards the low. Notice that the high is just $1 above the close, therefore the length of the line above towards the high is shorter, whereas the length of the line towards the low is longer. This particular candlestick hasn't been drawn to scale, but on our charts it is drawn to scale. These lines that you see are generally referred to as the wick. Now there can be many different kinds of candlesticks, and these are all based on the OHLC values. Practice makes perfect, and I'm wondering whether you are willing to do what is required to succeed. So I need you to practice making the following candlesticks with the OHLC values given here. There are 5 of these OHLC values, and therefore there will be 5 different candlesticks that you will be making. I want you to pause this video and solve this short assignment before proceeding any further. When we proceed, I'm going to solve all 5 of these, and if you've done them in advance, you will see where you made those mistakes, and this will help you correct your mistakes and be better at understanding candlesticks. Now while you're at it, also please subscribe to my channel so that you can be updated every time I put up a new video. So let's proceed further now. We'll take the first set of OHLC values. The opening price is 25, the high is 35, the low is 20, and the closing is 30. So just looking at these values, we can see that the open was 25 and the close was 30, which means that this is going to be a green candle because price has risen during this time period. So we make the body, we start out with 25 and move upwards to 30. And now we can add the upper wick at 35 and the lower wick at 20. So this is what your candle should look like. Were you able to get this right? I hope that you did, because this was pretty simple. If you have any problems, leave a comment and I'll try to answer your question as soon as possible. Let's do another one. So here we have the OHLC values at 110, which is the open, 110 which is the high, 80 as the low, and 105 as the closing. So just looking at these values, once again we look at the open and the close, and we know that this is a red candle because price has fallen during this time period. So we'll start out with 110 and then we'll move downwards, which will give us the body of the candle. And now we can put in our high. Now the high is 110 and there is no upper wick because the opening price was 110 as well, and then price just didn't go up any further up. It just started to fall. But we do have a lower wick, and we can draw this by a line moving downwards, and that goes down to 80. So this is what the candle should look like. Let's do the remaining 3. The OHLC values are 15, 20, 15 and 18. It's a green candle, price has risen. We'll start from the 15 and move it up to all the way to 18, and then we have the upper wick at 20. But do we have a lower wick? There is no lower wick. That's because the opening price was 15 and the low was also 15. The next one, OHLC values are 7, 10, 2 and 7. So is this going to be a green candle or a red candle? Well, price remained the same during this time period. It opened at 7 and it closed at 7. So we're just going to draw a straight line because it started at the same price as it ended, right? However, we do have an upper wick. It goes up to 10 and then it goes down to 2. So it looks something like a cross, but it doesn't have a body. This kind of a candlestick is called a doji candlestick. Now doji candlesticks do not have a body. Now let's attempt the last one. The OHLC values are 40, 40, 20 and 20. So right off the start we know that this is a red candle because price has fallen. We'll start with 40 and we'll move all the way down to 20. But are there any upper wicks or lower wicks here? The high and the low are 40 and 20. So I guess we're missing some wicks here, right? This is a proper candle, right? We don't have any wicks. So some people ask that, whether this is going to be an actual candlestick or not. Yes, it is going to be. And this kind of a candlestick is called a Marbuzu candlestick. We'll study more about these a little later on. In the previous video, we went over Japanese candlesticks, what they are, how they're created. If you remember, we also did some OHLC values and we made some candlesticks, and we also went over some of the commonly appearing candlesticks in a candlestick chart. Now students have a number of questions that they usually ask me, and I want to go over some frequently asked questions in this section. I'd like you to subscribe in the meanwhile so that every time there is a new video you will be notified immediately. So let's proceed. Let's just jump in. Opening price versus closing price. The most common question that people ask me is whether closing price of a candle is going to be the opening price of the next candle. So assuming that we have a single day, when the price closes, let's say at $50, is it going to open at $50 the next day in the morning? Well, the answer to that is that no, that's not exactly true. It may happen, but it doesn't always happen exactly this way. Now the reason is that the opening price refers to the first price at which a trade is taken when the markets open. So the first trade, let's say if the first trade happens at $50, then that's what the price is going to be. If the first trade happens at $52, then the opening price is going to be 52. So assuming that price is closed at 50 one day earlier, but the next day they opened, the very first trade was at 52, there's going to be a small gap in between, and the opening and closing prices are not going to be the same. The closing price in the same way refers to the last price at which the last trade is executed when the markets close. Therefore, it follows that we want to ask the question, why is there a change? Why is there a difference between this? Markets have already closed. Well, the reason for this is that there is a time difference, right? There's an interval, and during this time interval there could be some kind of news event, there could be an earnings report, there could be a political event, anything could change the market sentiment, and then buyers and sellers could have a different idea of where the price is going to go. So because all these trades are taking place due to demand and supply and what market expectations are, we cannot really say if the closing price of today is going to be the opening price of tomorrow. Now if there is a change, there might exist a gap, and this is called gap trading, but it's a little advanced for this course and this video, so we're not going to discuss it now. We will be going over gap trading a little later on once you understand the basics of technical analysis. The next question that people ask is, why do prices move up? So let's think that there is a group of people and all of them want to buy. They want to buy a particular stock. And now let's imagine that there's another larger group of people who also want to buy, and there's only one or a very few people who actually have or are holding on to the stock of a particular item that people want to buy. So naturally, when this person or these few people who, sellers who are holding on to the stock, see that there are so many buyers, they're naturally going to want to ask for a higher price. So when they ask for a higher price and there are more buyers in the market, someone is willing to pay a higher price, and so prices start to move upwards. So generally prices move upwards when there are more buyers than sellers. Now this is a layman explanation to this. There are a number of, if you go into the details, there's a lot more to this that's going on. But since this is a beginner level course and beginner level video, I don't want to go into all of the details right now because I don't want to confuse you. So similarly, why do prices move downwards? Well, let's assume that there is a group of people and they all want to sell, and there's another larger crowd of people who also want to sell, but there's only one or there are a few buyers in the market. So what happens is their prices tend to move downwards when there are more sellers than buyers. And I will be putting up another video where I will explain exactly how this process happens. The next one, what exactly is technical analysis, and can it be used on let's say cryptocurrencies or commodities, etc. So people have different questions, but basically what they want to know is, can technical analysis be used on, let's say, the US stock market, the British stock market, the Indian stock market? Can it be used on commodities and currencies? So basically technical analysis looks at the study of charts and price movements, and it can be used on anything. So the question whether you can use technical analysis on cryptocurrencies, the answer is yes. Technical analysis can be used on all kinds of candlestick charts and symbols. So once you know what technical analysis is, how do you use the support and resistance, how are the candlesticks, what are they representing, what are they trying to tell us, you can use it basically on any symbol anywhere around the world. It could be crypto, stock, currency, it could be any market, so long as there that particular symbol has OHLC data and you can create a candlestick chart. Technical analysis can be used to give you the trade entry and exit positions on any market anywhere in the world. Bulls versus bears. So what happens when a bull is angry and it wants to strike? So if you look at the picture, you'll see that the bull usually pulls his head downwards, he has his horns, and he hits upwards, and that's why we say a bull market is going to push prices upwards, just like a bull strikes upwards. Similarly, bear market is a bear always strikes downwards with his paws. So bears strike downwards, they push prices downwards. We can also call this a bearish market. Moving forward, the next video may seem insignificant for those of you who already know how to trade, but for the purpose of this course, all the beginners who have no idea about charts, this is a very important video that I would really like you to watch. It's going to show the live price movements of the struggle between buyers and sellers. It's only going to take a very short time, but you will get a very clear picture of how prices move up and down. This is Japanese candlesticks that we've been discussing, and in this video we're going to see the struggle between buyers and sellers. So let's move over to the live charts. I'm going to be working off the 1 minute time frame chart just to show you how buyers and sellers are constantly fighting in this market. So we moved over to our charts now. When buyers and sellers in the market are trading, when there are more buyers, prices tend to move upwards, and when there are more sellers, prices tend to move downwards. So we see this in the form of our live chart. This is the 1 minute time frame chart, and you can see over here that for the past 2 minutes here, prices have been moving upwards. Now, just to clarify, each one of these candles that is being made represents data or price movements for the past 1 minute. Now, there are different kinds of candlestick charts, and we'll go into that in the next section. However, what I want to show you is that prices are being driven down by sellers here. The buying pressure that existed over these two is breaking, is fading away. So buyers are not in control at the moment, sellers are in control, and they're driving prices downwards. So let's see what happens in the next couple of minutes. The reason why we're going through this exercise is because when you look at these candles that are already closed, we don't really understand what exactly happened during that time period. How many times buyers and sellers struggled? Was it a constant struggle, or was it just buyers that just push prices all the way upwards? Maybe there was no selling pressure at all. But when you look at the live candle moving up and downwards, we can see that in this candle, right, there is some buying pressure. Buyers are trying to push prices upwards, and then sellers are pushing it downwards. So there is this constant struggle. And this is important to understand, because a trader who looks at these candlesticks and these charts and the indicators, we should be able to read and understand. We want to be able to create a story, and when we understand the psyche behind what is happening, is there more buying pressure, is there more selling pressure, we can accurately predict what exactly is going to happen in the near future, and we can end up making some consistent returns on our trading. So as you can see, the selling pressure, the sellers, they weren't able to push prices downwards because price was pushed back upwards by the buyers. Now in this section here, again the sellers came in, they tried to push it downwards, but buying pressure is pushing it back upwards. Right now the sellers are in control, and let's see what happens. And then there you see sellers are pushing it even further down. And this is the kind of story that I want you to be able to do by the end of these series of videos. So in the next section, we're going to first study some time frames. We're going to look at some candlestick charts and the common types of candlesticks that exist. In this video, we're going to be doing candlestick charting time frames. In the previous videos, we've seen how to use the OHLC values to create individual candlesticks. But in this video, we're going to take candlesticks from one time frame and try to create a candlestick of another time frame. It's going to be fun and it's going to be easy. So in the meanwhile, let's subscribe to the channel and hit the alerts button so that every time there is a new video, you will be alerted of it. So candlestick charts are basically a group of candlesticks that are bunched together, and they are specific with a time frame. Now there are many kinds of time frames that are out there, and you can even generate your own time frames, but the most common ones are the M1, the M5, the M15, the M30. So basically the M stands for minute. So when you look at the M1, right, so each candle in that chart is going to give us the OHLC values for a past 1 minute. Each candle is going to be generated in every minute. So this is a pretty fast chart. The M5 again is going to be giving us the data for the past 5 minutes, and the past 15 minutes would be given on the M15. The M30 again is going to give us, it will give us the values for the past 30 minutes. Moving ahead, you have the H1 and the H4, which stand for hourly. H1 is for, each candlestick is for 1 hour. H4 means that each candlestick is going to be for 4 hours. And then the D1 stands for daily, and the W1 stands for the weekly. So each candle on the W1 chart is going to be representative of what happened to price over a 1 week period. Now I have the M1, M5, M15 and M30 in red, and I have the H1, H4, D1 and the W1 in green. The reason for this is that the M1, the M5, the M15, the ones in red basically, they're pretty fast time frames, and beginners shouldn't really be using this. If you are a beginner, you have very little knowledge, then I would suggest that you always avoid those until and unless you get very, very good at it, because even professional traders, full-time traders would want to avoid those time frames because at times it gives you the wrong signals. So always stick with the green ones, avoid the red. Moving ahead, we want to understand how these time frames actually work, and what I'm going to do is I'm going to take an example so that you have a very good idea how the independent time frames are working. We're going to take the M30 time frame for now, and the OHLC values are 30, 40, 20 and 35. Now in our previous lectures, we've seen how to create a candlestick based out of these OHLC values. If you haven't taken that video, or if you haven't viewed it, please go ahead and view that before proceeding further. So we have an opening price of 30 and we have a closing price of 35, which means that this is a green candle and it moves upwards in price. So let's put up our high at 40, let's put up our low at 20, and this is what our candle looks like. Now the very next candle in this chart is also going to be an M30 time frame candle, right? Because we're on the M30 chart. And assuming that the OHLC values are 35, 42, 25 and 39, we can go ahead and make the candlestick for this as well. I'm going to draw horizontal lines so it's a little easier for you to see where the opening and the closings are. We'll start at 35, it goes up, it's a green candle, closes at 39. The high is higher than the previous candle, which was at 40, because this one is at 42. And then we have a lower wick, which pushes basically prices down to 25, and then prices move back upwards. So our 25 is lower than the 30 and above the 20. So this is what the second candle in the M30 time frame chart would look like. So now that we have two M30 candlesticks, we can create a H1 candlestick. Notice that 230 minutes makes 1 hour. So let's try to do this. The H1 time frame OHLC values are going to be 30, 42, 20 and 39. But before we proceed any further, I'd like you to know why we got these numbers and how did we get them. So these two candles, when they're combined, will end up making the H1 candlestick. So we're going to start with this one. At the very beginning, price opened at 30, and so we'll have an opening price of 30 in the H1 time frame candlestick. Now price goes up to 40 in this chart, so we could put a 40 here, but then we notice that the M30 candlestick that appeared after this one has a high that is 42. That's even higher than 40, so we're going to put in the highest one of these two. Similarly, we're going to use the lowest value amongst both of these candlesticks for the low of the H1 time frame. So this turns out to be 20, and then we have the closing price of the second candle, because the R started around about here and it ended with this candle. So the closing price of 39 is going to be the closing price of the H1 time frame. Now we can start making the candlestick for the H1 time frame. So we have our body, it starts from 30, goes up to 39, and then we have the high at 42 and the low at 20. So what I want you to understand in this exercise is that when you have two candlesticks of the 30-minute time frame, you can end up making the H1 candlestick. Similarly, you can break up the 30-minute time frame into two 15 minutes or 6 5 minutes. Or you could have 30 candles of 1 minute that would actually be combined, and it'll give you this result right here. Now the advantage is that this candle, the H1 time frame, gives us a much more reliable view of where the market prices are going to go. However, there is a disadvantage of this as well. So moving over to the first candle that we made, here we can see that buyers are in control. Price moves upwards. There is a bit of a struggle between the buyers and the sellers, and there's always going to be that struggle. But at the end, buyers are in control and they drove prices upwards. Moving over to the H1 time frame, we see the same thing. Buyers are in control, price moves upwards, goes all the way to 42, it goes down to 20. But what we don't know is that what exactly happened within this time frame. So moving over to this candlestick, right, we're seeing that when price moves up and closes at 35, right, and this candle opens at 35, the sellers came back into the market and they pushed the price down to 25. Now the buyers were losing at this point, but then the buyers stepped in and they pushed the price back upwards. Now this is the advantage of moving to a smaller time frame. So this also falls under the multiple time frame analysis strategies. So we're going to look at the H1 time frame to make our trades. However, if you want more detail, and this is what advanced traders usually do, I don't want you to get into this right away. I'm just bringing this to your knowledge so that you have a good idea of how this works when we actually get into it. So this candlestick says buyers are in control. Here we can see that there was a struggle between the buyers and the sellers, but the buyers eventually succeeded, and even on this candle the price moved upwards, which is why it is a green candle. So let's move ahead and try to do another example. On the screen you're going to see the two 30-minute time frame OHLC values, and you see the H1 time frame OHLC value. I want you to pause the video and try to make this and come back once you're done, because I want to see if you get it right, and if you have any problems you'll be able to see what mistakes you made. So let's proceed. The M30 time frame OHLC value is given here. Say that the opening price was 30, price moves up to 35, it goes up to 40, and then the low is at 20. This is the same one that we did in the previous slide. Then we'll move over to the next one. Here price moves downwards, it goes from 35 to 28, the high is at 42 and the low is at 25. So we have a bearish candlestick here. Sellers are basically in control. Buyers did try to push the price upwards, but then eventually the sellers managed to pull the price downwards. So let's go ahead and make the H1 time frame. We have a very short body here. Price opens at 30, it goes down to 28. There is a huge upper wick which goes all the way up to 42, and the lower wick goes down to 20. So what we can see is the first candlestick on the M30 time frame, buyers are in control. The second one, buyers lost. So buyers, when it opened, they tried to push it all the way up. So price went up, but then sellers came in and the selling pressure was so high that it went all the way down. And at this point, some buyers did manage to push the price back upwards. So it didn't close at 25, it closed at 28. Looking at the H1 time frame, we know that buyers made a good attempt, but sellers pushed the prices downwards. The sellers are in control. So it's important to look at a number of different time frames. When you get a hang of this, it's going to be very easy for you, provided the basic information, this basic knowledge has been built in. Right? So if you're accustomed to this, then later on it's going to be very easy for you. Now every candle represents a struggle between the buyers and the sellers. So what traders want to do is they want to be able to create a story. We've tried to show you the struggle between the buyers and the sellers in the live video that I presented right before this. And this is basically just a confirmation of what exactly is happening when the candlesticks are being made. This kind of analysis of price movements through the charts and candlesticks is called technical analysis. Now, this is basically the beginning of technical analysis that we're going through. There is a lot more to this, but these are small steps that we're taking, and by the end of this course you should be able to get a very good feel of where exactly you're going and what you can possibly end up achieving. Now, I'm leaving you with an assignment. I want you to go out, try to find some candlesticks on Google or anywhere, and try to come up with a story. What are the buyers and the sellers up to? When are the prices going up? Where are they going down? Try to create a story, and if you have any problems or any questions, feel free to message me in the comments section below. So when you look at candlestick charts, you will find a number of candlesticks that look pretty much similar to each other. And over time, people have actually named these candlesticks. Now there are a lot of candlesticks, but I'm not going to cover them all. In the next section, I'm going to tell you about the ones that I think are important for you to know so that you are able to make good and consistent profits. In this video, I'm going to go over some candlesticks that keep reappearing on our charts. These candlesticks have names, and some of them are pretty important in my opinion. So let's get started. If you're new to this course, please subscribe to this channel and click the bell button to enable alerts. You can also take the entire course from the beginning by visiting the playlist section on the channel. So a doji, a gravestone doji, and the dragonfly doji are candlesticks that have the same opening and closing prices. This means that prices open and then buyers push the prices upwards, sellers push the prices downwards, but by the time the market closes or by the time that candle closes, the closing price is exactly the same as the opening price. So essentially, these kind of candlesticks do not have any body. And by looking at this, we see that the opening price and closing price on all three of these is the same. This is a regular doji. This is a gravestone doji because it looks like a gravestone. And this here is a dragonfly doji. What happens here is that price opens and then buyers push the price upwards, sellers push it back downwards, and by the end it closes at the same level. The same thing happens here. It opens right about there and then sellers push the price downwards. There is a struggle, buyers push the price back upwards, but no one is really able to succeed and price closes at the same level. So this basically represents indecision in the market. And it's very difficult for us to say whether prices are going to go up or they're going to go down. Therefore, In general, this is a neutral candlestick, which on its own cannot give us any direction as to where market prices are going to go. However, if let's say prices were going up and then we see a doji, it kind of suggests that previously the buyers were in control and now their strength is fading. So a doji appearing after a sustained upwards movement can signify that prices may start moving downwards. And the same goes for a doji that appears after a sustained downward move, because it signifies that prices may start moving upwards now. Now almost every trader knows about the doji, but I am not too fond of them and I don't use them often. The complete opposite of the doji would be the Marubozu candlestick. This kind of candlestick has no wicks, it is all body. So the green body candlestick means that buyers rule and the red body candlestick means the sellers rule. Now these kind of candlesticks are a clear indication of where the market is headed over the next few candles. Next up, the hammer. Price opens right about here. Then sellers push the price downwards. Buyers step in and push the price back upwards. But that's not all. The buying pressure continues such that by the time the candle closes, the prices move in the green direction and the body is green in color. So on here, the price opens. Sellers push the price downwards, buyers push the price back upwards, but by the time the candle closes, it's still in the red zone. It has a red body, it has a red wick. However, both of these candlesticks are bullish in nature. So this is because both of them show buying pressure. But one of them, the green one, is obviously far more bullish out of the two. And if you look more closely, you will see that the shape closely resembles that of a hammer. Now an inverted hammer is the same story as a hammer. The only difference is that price opens right about here and then buyers push the price all the way upwards, sellers come in, they push the price downwards. By the time the market closes, this is where the prices end up closing and it looks like an inverted hammer. On this side here, price opens round about here at this level and then there is buying pressure. Buyers push the price upwards, sellers push the price downwards. It comes almost to the opening price, just like sort of like the gravestone doji, but then sellers have this extra push and they push the prices downwards, and you notice that the price closes below it opens, which is why it is a red candlestick. And this kind of candlestick is far more bearish. Both of these are bearish, but this one, the one with the red, where the sellers managed to push the price even further down, is more bearish in nature. These kind of candlesticks are also called pin bars. So you can also call them hammers, you can call them pin bars. There is a slight difference between the two, but I'll just get to that. The important thing that you need to know is that the wicks in both of these, whether it's a hammer or it's a pin bar, the wicks need to be twice as long as the body. So if the wick is not twice as long, we wouldn't call it a pin bar, we wouldn't call it a hammer. Now as far as the slight difference between the hammer and the pin bar is something like this, right? So the hammer may have a slight, upper wick, which is hardly noticeable. But a pin bar is not going to have any wick on the lower side or on the upper side over here. So when these candlesticks appear, traders get a general idea of where the prices are going to move, and then they can place their trades accordingly. But the important thing, and the most important thing that I really want you to understand, is that we never look at just the candlestick, before placing the trade. This is one element of placing that trade. We're going to look at a number of other factors. We combine and make it an entire, a story before a trader is going to plunge in with his money and take that risk that is involved with each trade. Moving on, there are a lot of candlesticks that have names such as the spinning top and the shooting star, etc., etc. But I'm not going to be going through all of them in this course. What I want you to do is I want to focus on some candlestick patterns, because that is what is going to actually get you somewhere. And the first pattern that I want to go into is the pin bar pattern. So let's dive in. Pin bar formations, right? So we have bullish pin bars and we have bearish pin bars. We've already seen that in the formation of the candlestick itself. However, let's take an example. If prices are moving downwards and we have, a downward candlestick right there, we have another one right there, and this could be, 4 or 5, or it could be just 1 or 2 candles. It could also be 10 or 12, candles in a straight line going downwards. And then at one candle we have a pin bar formation where prices open, they move down, the selling pressure fades away, the sellers are not able to control the price there, and buyers step in. There's too much buying pressure, it pushes prices upwards, and it closes right about here. So this shows a lot of struggle between the buyers and sellers. On these two, it seems pretty much that the sellers are in control. Price just it just moves downwards, buyers are not able to do anything at all. So what do we expect when some things like this happen? We expect that prices are going to move upwards. So we have a upwards moving candle that should appear in most cases. There may be times where there is another struggle, sellers try to push the price slightly downwards. You may see a small wick, but what is expected is that after such a pin bar, prices are going to move upwards. Similarly, you could have another pin bar formation which is bullish, but it is a red candlestick. Notice that we can see that the body of the candlestick is, the wick is basically more than 2 times the size of the body. So whether it's green or it's red, right? So we expect prices to move upwards. The important thing is that this kind of formation is stronger than this one right here. Looking at the bearish pin bar formation, right? So we have prices that are rising, and then suddenly we have this pin bar that is inverted, it's upside down. We have prices opening around about there, it goes up, the selling pressure steps in, and then it comes back down and closes in the red. So this is it's a pretty clear indication that prices are going to head downwards from here onwards. Again, this is just the first part of what we traders look at. We want to see the bullish and the bearish pin bars, but then we want to confirm this by looking at some other factors which we're going to discuss in the next courses. Next up, we have the engulfing patterns, which will have the bullish engulfing and the bearish engulfing. So we have a series of downward candles which shows that prices are moving downwards, and then there is this bullish candle that pushes prices upwards. What we want to see is whether the previous candle or the second last candle here is completely engulfed by the new candle or not. So we're going to take the opening price and the closing prices of the previous candle, and here we can see that the range or the entire size of the body of this candle is smaller than this one. That's the first thing. The second thing is that the entire body needs to be completely engulfed. So if the opening price of this candle is slightly above, and then we have some part of the previous candle that falls outside the body of the new candle, it's not engulfing. This candle in the entire body needs to be completely engulfed. That is the important thing. So whenever you see this, we expect that prices are going to go higher. They're going to move upwards. Let's look at the bearish engulfing. So we have a series of prices, candlesticks where prices are moving upwards, and then we have this huge candle that, it's a red candle, bearish candle that moves downwards. Again, the same rules apply. We need to make sure that the previous candle, this one here, is completely engulfed by the body of the next candle. The important thing is that whenever this happens, it's going to send prices downwards, or at least that is our expectation. We want to make sure that the wicks are not involved in this decision making process, right? So it's only the bodies that we're looking for. The wicks are going to be completely ignored. So there are a lot of patterns that you can use, but these two patterns are very, very important. They're very powerful, and if you can master just these two patterns, it's going to go a very long way in earning you consistent profits. So we're going to analyze some charts together, and we're going to find some engulfing and pin bar patterns soon. But first, if you want to learn about all other candlestick patterns that are out there, you can come over to the Candlestick Pattern Dictionary and just search for it on Google, and you'll come here. This is the exact address, and this website basically gives you an outline of all the different kinds of patterns that are there. I'm not saying that you should be trading all of these. I personally believe that being better at just one or two is the key to success, because there is so much information out there. I don't want you to go through everything and try to confuse yourself. But if you still want to learn just for the sake of learning, that's perfectly fine. You can also move over to the investing.com website, and here under the markets, go into stocks, and then you can just open up any one of these stocks right here. Let's just close this. Let's go with Apple here. When you do this, it's going to open up the Apple's stock chart. And you can see that this is just a straight for aligned chart. What you can do is you can click on the candlestick icon here, which is going to show you all the candlesticks, and then it gives you the the day's range, the previous open. It gives you a number of other details like the EPS, but this is not really involved with technicals. So what I want to do is I want to come up here into the technical section. Just click on that. And now we have, I need to get rid of this. Okay, so now we can go into candlestick patterns. And there we have it. You see, what you can see is that on this chart, they have labeled each one of these candles wherever a pattern is appearing. And a pop-up shows us what kind of pattern it is, how reliable it is, and when it was formed. You can also go in and look at some of the patterns that have been made in the recent past. It will also give you the hourly, the time frame that this pattern is appearing on, and the exact time, and how reliable it is. So this particular pattern, the evening star, appeared on the H1 chart. This one appeared on the weekly chart. This is on the daily chart, and then we have this engulfing bearish pattern on the monthly chart, and this happened in the month of May. So you can open up different kinds of charts. You can maximize this. You can change the chart levels as well, right? The time frames, and then see how it actually works. You can explore this. It's actually a wonderful tool, because the more practice you get at this and the more exposure you get to the particular patterns that you're trying to master, okay, it's just gonna help you. So moving ahead, Here I'm putting on a chart on the screen. What I want you to do is I want you to find engulfing candlesticks. I want you to pause this video, go through the entire thing, and when you think that you've found all of the candlesticks that are engulfing patterns, come back and start playing this video again. And we will go through some of them together. Okay, so let's proceed. The first one that we see here on the left side seems to be a bullish engulfing pattern here. But if you zoom in, we're going to see that the red candle, the body of this candle, remember we are going to ignore all the wicks, right? So we're only looking at the bodies. So the closing price of this is lower than the opening price of the next candle. So this candle here is not completely engulfing the body of the previous candle. So this may seem like a engulfing pattern, and the end result is that yes, prices did go up, but it doesn't fall under the engulfing pattern criteria. So this one here, this is an engulfing pattern. If you see that the body is completely engulfing the previous one, and then price did go down for the next three candlesticks, but then it moved upwards. The next one is this here. This is engulfing the previous one, and then the next candle and the next few candles we see is they've remained above the closing price of this candle here. So whenever you see a bullish engulfing pattern, what we're expecting is that the next few candles should go higher than that previous one. So that gives you some room to make some good profits and then exit the market very quickly. So moving forward, this again here is another bullish engulfing pattern. Immediately after price closes here, what we see is that sellers and buyers get into a struggle. The buyers try to push it slightly upwards, but then the sellers gain control and then move downwards. So this is sort of like a spinning top, right? But then prices start to move downwards. So if you did get in, you would be getting out somewhere around about here. Let's go forward. Let's see this one. So here again, we have a bullish engulfing, and then price moves forward. Again, another bullish engulfing, price moves upwards. This here, this candle is a bearish engulfing. Now the reason why I have this in red is because this is one of those candles where price actually didn't go further down. As a matter of fact, it just went in the opposite direction. So this is basically a fake signal that we received. So even though bullish engulfing and pin bars, etc., all of these patterns, they give us some pretty reliable information, but it's not always accurate. It's not always going to happen in that way. So I want to explain this. When these patterns are formed, even if we are very experienced in trading them, we have to look at certain other factors as well, such as indicators, etc. We have to make up a strategy, and this is something that I'm going to explain to you in the next courses. So you don't need to worry about it, but just really need to remember that there is more to it, and you need to learn more before you actually put up your money and start trading in this way. So we have another bullish engulfing pattern, and then price goes way upwards. Here it's a bearish engulfing pattern, price moves downwards. There we have another bullish engulfing, and price moves way upwards. Bearish, and then bullish, and then another bearish. Now even though price didn't really close way down there, just as we saw, it went up and closed really high, similarly just kept going downwards. What happens here is that the very next candle, buyers try to push price upwards, but then sellers manage to push it downwards. So if you were to get in or into this market here, you would probably be getting out somewhere over here, and this is part of a strategy which I'm going to be explaining later on. Again, we have a bullish engulfing, price moves way downwards, but then buyers come into control, and they push price upwards. Bullish, and then that is also bullish, but then again it's marked in red because over the next few candles, basically what we're looking for is that immediately after the bullish or the bearish engulfing, we want the price over the next few candles, it needs to go in that direction. So this is not happening here. We have a bullish engulfing, but then price, it just relatively stays below the closing of this candle here. So that's why I marked it in red. We have a bullish engulfing, price does go upwards, again bullish, it goes upwards. It gives us some time to make some profit and get out, and then we have this huge bearish move following the bearish engulfing pattern. Moving ahead, here is another chart. Actually, it's the same chart. I just want you to find pin bars instead of engulfing patterns here. So pause the video, go through this, and then come back when you're done. And now let's proceed. So this here looks like a pin bar. It has a body that seems to be the body, the wick is basically more than 2 times the size of the body. That's one of the rules, but it doesn't really qualify because it has this lower, this pretty large lower wick. So ideally, if the wick is very, very small, almost negligible, we could classify that as pin bar. It looks more like a hammer because it has that lower wick, but then if you note that the body itself is also pretty large, right? So it doesn't really look like an inverted hammer. So this doesn't fall into the category. We're going to go through some more and you'll see what I mean. So this here it looks like a hammer as well. It's also a pin bar. The upper wick is like much smaller than this one, right? So we would expect that prices are going to move upwards. It also falls under the same, it has that rule is perfectly fine here, that the body, the wick is at least more than 2 times the size of the body. So and we see prices go upwards. This is also a pin bar here, and then price moves downwards. Here is also another pin bar, which would suggest that price is going to move upwards. And then this one here. So prices have been generally stable in around about this area, and then we have this huge upward movement, and then here buyers step in, they keep driving the price upwards, and then for some reason the sellers come in and they push the price downwards, which results in this formation. Again, the lower wick is it is pretty long. It shouldn't be that long. This needs to be all the way at the end, but it still does qualify because the body is really, really small as compared to this one, right? So the body was pretty big, and then prices start move downwards. So we're not only going to be looking at this once again. What I can see just by looking at this chart is that there is a a very pretty strong level of resistance right about here. So which is why we see the price moves downwards. It moves downwards again over here. So it's sort of like a line that's going right about here. But since we haven't done support and resistance so far, that is something that we need to do in the next lecture, right? So in the next lecture, support and resistance, the levels, entry prices, etc. is going to be a lot of fun. Join me, and we are going to do some live examples on real charts as well after we've done the theory. Section, we're going to do support and resistance. So support is a price level where buyers are coming into the market and they start buying. So sometimes when prices are falling, people start to believe that they've fallen too much and that they're not going to go any further down. The price is very, very attractive, And since prices are low, people want to buy, and they want to buy because they can make a profit when prices move back upwards. So let's take an example. Let's say that a bag of rice sells for $10 a year, and for some reason, due to a bumper crop, etc., price just drops to $5 a bag. Now, a group of people may say that, look, this was $10 earlier on, we've been buying it for $10, it's worth $10, and now that it's at 5, it's it's a very good price. We should just buy it and hold it. Maybe we can consume it next month onwards. We can save up or reduce our household costs, etc. So demand basically goes up when price falls. Now, let's say that the price goes even further down. It goes down to $2 a bag for rice, right? So a lot more people than before will want to come in and buy because they think that this is a bargain price. They should just hold it for a month or two, or maybe a week, or maybe a few days, and it's just going to bump back up to $5, and they're going to make a pretty good profit. It also brings in traders, it brings in household consumers, it brings in everyone basically. So this is showing that buyers start to step in to buy a product when prices go down. And when this happens, where buyers step in, this level of price is called a support level. So when there are more buyers than sellers, price goes upwards. And similarly, in different words, we can say what happens when prices reaches a support level. Well, it's pretty simple. Support will always push prices upwards. Similarly, resistance is a price level where sellers are coming into the market and they start selling a product. So when prices are rising and they're going up and they're going out of control, things are becoming very expensive. People wouldn't want to buy. They want to sell. So if anyone is already holding on to some kind of product and that price goes very high, they can just sell it off in order to make a good profit. So we're going to take an example again, using the same example. Let's say rice is selling for $10, and maybe you bought let's say 5 bags of rice, and we were thinking that you're going to use it over the next couple of weeks or couple of months, etc. Maybe you're a trader, or you trade with rice and you buy large quantities and you sell. So when price, let's say, reaches, it just shoots up to $20 a bag, a lot of people would say that, look, we're not going to use it right now, and probably prices are going to go down just in a week or two. So they may want to sell it. They don't want to buy anymore. So when you stop buying, the demand goes down and the supply increases. So let's say we'll just make this a little more interesting. That a price goes up even further up to $25 a bag. So people who are holding on to large stocks will just say this is an unbelievable price level. We've been buying for much lower. We've been selling for $10 all year round, and now the price is at 25. That's like 150% profit. So everyone is going to want to sell, and buyers are not going to be there. So prices, when supply increases, prices start to drop. And this level is called a level of resistance. So every time there are more sellers than buyers, prices are going to go downwards. And in other words, a resistance level, when you reach that resistance level, prices are going to move downwards. Now, this is a general rule that is studied even in economics, and it may be new to you, for some of you. But as we go on with this course, we're going to look at some charts, etc. We'll get a lot of practice. This is just going to come very naturally to you. It's very easy stuff. Now we need to apply this information onto a chart. So you can see a candlestick chart with prices moving up and downwards. Below, right here, there is a support line and there is a resistance line up here. This is drawn just to try and explain the situation to you. When prices reach a support level, when they've been going downwards, buyers step in and they push the price upwards. Now when price is moving upwards, there is a level at which people think that this is, just too overvalued. Resistance comes in and price starts to move downwards. Again, as price moves upwards on this candle, you can see that there's a big struggle between the buyers and the sellers. Buyers are trying to push price upwards and sellers are trying to push price downwards. Eventually, we see that the sellers are successful and price moves all the way down. It just gets knocked all over to the support level, which is where buyers come in again and push the price upwards. It reaches resistance and then it comes back down to support and then moves back up to resistance. These are support levels. Now, every time we want to confirm that this is a valid support level, we need to look at the past. We need to say, has this price level been tested before? Have buyers and sellers engaged in a struggle in the recent past where the sellers have failed and the buyers have managed to push prices upwards? So this one depends on the one right before. So every time if price were to move downwards, right, so we're going to be looking at the previous support level. Similarly, if this part of the chart did not happen, we would say that prices are moving downwards here. So we would be looking at this level here. So on our charts, we're going to draw this long horizontal line, and then maybe a little later on we can see the price moves back downwards, and we already know that at this level buyers came in and pushed the price upwards. So if price were to come all the way down here, we know that this is an entry point. We want to buy because prices are likely to go upwards. So similarly, when resistance steps in, the sellers are going to be pushing prices downwards. So we can see by these two that these are levels of resistance. This one is going to be, whenever price reaches this level, we're going to look at the past, and since there was a downward push right there, we can confirm that yes, this is a resistance level. Similarly, at this point here, we don't know what's going to happen next, but what we are going to see is that at this same level prices have been moving downwards. So our expectation of price movement is that there's going to be a retracement, is going to go downwards. Sellers are going to overcome the buyers. Now in this kind of situation, if you already bought at this level here, this is the point where you need to get out of your trade. Perhaps prices are going to go downwards, way downwards, and you can buy it again and then sell it when it reaches the resistance level. So a very effective and very basic strategy of trading is that you buy low and you sell high. Now you can also short sell in certain markets, in certain symbols, which would mean that every time price comes down, you will buy. At this level, you're going to sell out. Then price comes downwards. You can buy at this point, but let's say if you were to miss out and prices were somewhere at this level, so you could probably just wait. If this trade didn't go through, you could just come here and you could short it, and then prices are going to move downwards. So here we have another chart, and let's go through this and try to apply support and resistance lines. Now when we have a chart and we want to start out making support and resistance lines, we need to start somewhere in the middle or towards the end, but not all the way to the end of the chart and not all the way at the beginning. This is because we want to look at what has been happening in the recent past in order to be able to predict prices in the future. So I'm going to start out with something like this, some level right here. I'm seeing the prices are moving upwards and then they start moving downwards. So I'm assuming that there is a level of resistance, and I'm going to draw a small line right about there. So resistance is a level where prices are driven downwards. So let's learn by practice. We're going to draw a small line. And now that our line is there, we need to confirm whether this level is actually valid or not. So we'll draw another line at the same level, but sometime in the recent past, and let's do another one right there. So we can see in both of these instances that prices have been moving upwards, and then they moved back right there, and then selling pressure came in, price went down. Similarly, price came up here. The sellers were pretty successful here at driving prices all the way down. And then similarly it happened here again. So this level is actually a valid level, and so we're going to draw a long line of resistance. We don't need these individual small lines anymore. Now we're going to go in and we're going to say that prices have been going down in all three of these instances. Let's do some support lines here. So this level or this zone is where prices have been, the downward movement has been stalled. It didn't really go upwards, but then sellers pushed the prices back downwards to that support level, and then there was this huge upward move. But in order to confirm this, we just can't jump to a conclusion. Even though we see a huge upward trend in price, we still need to go back and confirm whether at that level buyers stepped in sooner or later. In certain cases, just like here and here, sellers just stepped in immediately. But over here in this price level or in this zone, we see that the selling pressure did fade and price moved back upwards. So yes, this is a valid level of support. And every time we have a valid support level, we expect that prices are going to move upwards. Now, once prices have moved upwards, we see that they break through our resistance line and then they come back to the same resistance line. So even though buyers have been in control and they managed to break through this line, the sellers stepped in and pushed the price back downwards. Now this is the second step that we need to learn about support and resistance. So basically, price keeps moving back and forth between the support and resistance levels, but sometimes there's going to be a break in the resistance level or in the support level. In this case, you can see that there is a break of the resistance as price moves upwards. And whenever we see this, price moving above the resistance, this buying pressure is bound to fade and sellers are going to step in and they're going to drive prices back downwards. Now whenever this happens, we see that the resistance level later on after the break turns out to be the new support level. So as prices push upwards, sellers come in, they push the price back downwards, but at this level now, which was the previous resistance, is now going to start acting as support, and then it'll push prices back upwards. So essentially what happens is that we have a new level of resistance and a new level of support. Once prices come all the way down to the support level and then they start bouncing upwards, this is a clear sign that this level of support is now valid. So ideally, you do not want to trade at this point. You want to let the price bounce back upwards, and now every time it comes back to the same level of support, we can accurately say that now there is a large possibility that prices are going to rebound upwards. And this continues to happen again and again until a support and resistance is broken. When a support level, on the other hand, is broken, this support level becomes the new resistance. In the next video, we're going to move over to the investing.com website where we will open up some real charts. We'll apply the support and resistance lines and we'll see how price is driven between them and what happens when the support and resistance lines are broken. The previous videos for this course, we have already gone through what Japanese candlesticks are. We've done some patterns. We've seen support and resistance. In this video, I want to acquaint you with a trading platform. Actually, it's a website that gives us a lot of information regarding charts and how to analyze them, etc. It makes things easy for us. So what I want you to do is come over to the investing.com website, and under markets, just click on stocks. Now this is by default going to open up a list of US based stocks, and here we have them. It gives you the last, the high, the low, and the percentage change, the volume, etc. And these keep changing when the market is open. Here you can choose a number of different indices, and each one of them is going to have a listing of another, some other stocks. You could also change the markets. You can go by continent and choose your country and pick your stock market, and then you could go ahead and pick whatever stock that you want to analyze and trade. So let's go with this one right here, and for the purpose of this video I only want to introduce you to the website, and then in the next videos we're going to actually try and place our support and resistance lines. So now that this chart is opened up, let me just get rid of this video. You could click on the candlesticks, and this is going to give you a candlestick chart that is on the daily time frame. But we don't want to use this kind of chart because this is just a basic chart. We want to go into a streaming or a live interactive chart, which is why I clicked on the technical chart, and this opens up the American Airlines chart right here. I want to maximize this, and then since this is a line chart, we are really not interested in this. We want to go in and click on this thing here which says candles, and it's going to convert the chart into a candlestick chart. We haven't really discussed volumes and how they come into play, so I just want to get the volumes out of there by clicking the X mark. Now on the right side we have the price scale, on the bottom we have the time scale, on the left side we have a large number of tools. But for support and resistance we're just going to use this top one. If you click on the right side of this, and then we can choose the horizontal line. Now we could place this anywhere. We could change the size and change the color, etc. We can also right click, go to format, and then change things over here. You can change the coordinates. So let's say if I want to make this at 35, I could just enter that and click OK. So it's going to automatically adjust at that level. This kind of makes things a little easier. Now you can also delete this by clicking on that and pressing the delete button. You can zoom out of the chart and zoom back into the chart using the wheel on your mouse. Now on the top we have the different time frames. So right now the 1D is in slight blue color, which means that this chart is the daily chart. This is also given here, American Airlines Group, United States. D stands for the daily, and it's on the NASDAQ. And then here we have settings. We have the open, the high, the low, and the close. Notice that as I move my cursor around, the OHLC values keep changing because these are the values of each specific candle. You'll also notice a D over here, which basically stands for dividend, but this has got to do more with fundamental analysis than technical analysis, so we're just going to ignore it for now. We don't want to look into that. Basically we're looking for the chart, and this chart is going to be able to tell us whether prices are going to move up or down. Now before we move on to the next video, many times you will come to hear that the currently the stock market is going up, and it's very good, we're making a lot of profits, maybe from friends, maybe from colleagues, maybe from family members, etc. And they may give you a tip that American Airlines is going up, you should just buy that stock. It's it's going to go up to 300, it's going to go up to 200, etc. The point of all of this is that we don't want to take any person's or any experts' advice. We want to look at the actual chart, which is going to be able to tell us whether it is the right time to buy or not. We don't look at news factors, we don't look at sentiments, we don't look at anything else. The only thing that matters is the chart in front of you. That is it. So in the next video, let's go in and apply some support and resistance lines, and then we'll discuss how to get in and how to get out of the market. We're going to continue where we left off in the previous video. We have the American Airlines chart open, and we're on the daily time frame. So each one of these candles actually stands for one full day's worth of trading. So what I'm going to do is I want to move back into my chart, but we want to be able to place our support and resistance lines, right? So the first thing I want to do is that I want to analyze the movement of this chart right here. So prices move upwards, they come down, they don't go all the way down here. Sellers push the price downwards, there's a upward push, but the buyers are not able to maintain hold around about at that level, and then it just drops drastically all the way down here, which is where buyers come in and they push prices upwards. There is this struggle, it comes back around about to the same level right here, and then it just drops all the way again. So basically this point and this point here are showing that there's a huge decline in prices, which means that sellers are coming in and they're pushing the price downwards. So what does that mean? It means that there is a resistance level somewhere over here. So what I'm going to do is I want to take this horizontal line tool, just going to click on this one right here. Now we've already made this black in color, and we've made the width slightly bolder, and I'm going to go and click right there. Now we can see that this is roughly a it's a good point. It could be slightly above, it could be slightly below. It doesn't really matter that much, and I'm going to give you a tip on how to exactly fine-tune this, but a little later. So prices just come up and they go down. We can verify, we can see that, look, this has been happening a couple of times. So at this point we weren't really sure. It came back and then went back to the same level, and then it dropped. So we were pretty sure that, okay, this it has happened for a second time, so it is a valid level, and then it comes back up here and then it starts to go down. So we're pretty much sure that there's definitely something going on here. There is a resistance level, and then so this is the point where you actually get out of the stock, or you could just short it and it goes all the way down, and then it doesn't really go back up, and this is the end of the chart. We don't have anything beyond this. Now whenever we're applying support and resistance lines, right, so you basically need to build your chart. So if I want to trade sometime in the future, or maybe let's say in a couple of days, then I want to move back into my chart, and I'm going to do that by pressing or holding down the control key and then pressing the backwards arrow, which is going to move the chart back quickly. Okay, and now you see that my resistance line that we drew is it's gone all the way down here, and we see that it's still valid. You see, prices just came down, sellers pushed the price down, but then even in the past buyers still stepped in at this point and they pushed the price upwards. So what I want to do is I want to move through this chart and keep applying the support and resistance lines. What is this going to do for us? Well, it's going to build our chart. It's going to give us all the support and resistance lines, so that any point later on we can just load up our template for that chart, and it's going to be easy for us to trade. Now you can also create a free account on the investing.com website, and then you can just upload this or save the template, and then you can always download it or apply that particular chart. That makes life a little easier. So we're seeing the price moves downwards and it goes up, but we don't have any kind of reference point. It doesn't really go back down for us to confirm whether there is a support around about here or around about there. So I'm going to just wait and just move a little forward, and then we'll see that, okay, so this this seems like 1, 2, 3 and 4. This seems like a good point for resistance. It is being applied there. Now I could move this slightly higher and about there. And then you can also use the forward arrow key. When you do that, it's just going to move one candle at a time, which is actually very good to learn, because you don't want to see the chart before you make any predictions. Remember that practice is a very important tool. The more practice you get with drawing these support and resistance lines, the more time that you spend on analyzing the charts, the better you are going to get at it. So here again we see price just comes back up to the same level. It's around about at 50, and then let's see what happens. It just breaks through for a little bit and then comes back down. So here what happens is that it breaks up again and then comes back down. Now when price reaches this level, right, so traders who have a lot of experience, who've been doing this for a long time, can just take a good profit right about there. They could just short the stock and then come back down. When it comes here, take profit of $1, etc., get out, and then wait for it to come back up. And when it just breaks through, you could just come back down. The important thing that I want you to take out of this is that typically you don't wanna buy at this exact level. So resistance is always a level where you want to get out of the market. So if you buy at a lower price, you can sell out at this price here, or if your market allows and if you're into the shorting of stocks, that's up to you, but you could this would be the point where you would sell and try to take profit when prices go downwards. So let's go a bit further. You see the price goes down, and then at this level again, this is pretty close by, right? So we could just we could draw a line here, and this would be a support line. You also see that there's been this slight struggle here, but here it's being confirmed pretty it's pretty strong here that prices went down and buyers stepped in, price went down, buyers stepped in, and then went back up. So sometimes what is going to happen is that you're going to buy at this level right here, okay, because support is always a level where you buy. So when you buy and price goes up over the next 2 weeks, it goes up all the way to your resistance, and you sell out at that point. Now if you notice, price keeps going upwards, it goes up a little bit more, and you're wondering at that time, what did I do? It went from 44 or 43 and a half to 50. I made a very good profit, and then it just went a little bit further up. So basically, had you stayed in the trade for the next couple of days, you could have made $2 or $3 extra on that. But the educated way and the proper way is for you to get out at that resistance level. You need to control your emotions. You need to know how much profit is actually you're going to be taking when you enter into the trade. You can't just keep changing your mind when as prices are moving. So that's one of the main reasons why a lot of traders actually burn up. They make some bad mistakes, some emotional mistakes, and they burn up their account. So this is something that you don't want to do. An educated person is always going to get in on the support level, and he's going to get out at the resistance level. And then we know the prices, they keep going up and they keep going down. We'll have another opportunity. There are so many stocks out there. It doesn't mean that you only have to trade this one stock. You can trade any number. You could be analyzing 10 different stocks charts that you think are worth it or good companies, and then as soon as you get an opportunity, you could get into another trade. So again, so this is another level where you could just come down. You could just sell out if it retraces. You could just come back and sell and buy. So this is, again, you see price has gone way down. So you could wait for a little bit further, a downward move, or you could just buy at that level and wait for prices to move upwards. Now as we move through our chart, right, so our point here is actually to set up some support and resistance lines. So this line right here, let's just let's make it right about there. So we have another resistance level, and now when we move forward, we see prices going down. And so I'm going to zoom out a bit to see whether I already have. So I have a we have our original resistance here, and see what happens is that price goes back upwards to this. It acts like a resistance and then it comes back down. And this was that point where we had no reference, right, just in this earlier in this video. Let's see if we have something that we could draw a line on. No. So at this point we can see 1 2 3 around about at the 30 level. There's another level of support, so I'm going to draw one right there. You can just zoom in, and then let's just go forward. Okay, all right, so this here, right, so this low here and this low here, this corresponds to it. It's basically at the same level. So I'm going to draw another one round about at 25, slightly higher, right about there. Yes, so this is also now verified as a level of support, and this is where you would want to buy. It goes up, you get out, it comes back down, so you want to buy again, and it goes back up. And so we come to the end of our chart. Now we can zoom out and we can see that there are so many levels of support and resistance that we've placed, and this is basically how we can use this information to make our trades in the near future. So now if you go back to the very beginning just of this video, we have no idea whether we want to buy or we want to sell. So at this point we can see that price went up to the resistance level. It broke the resistance slightly, came back downwards, buyers came in. This support, this resistance level acted as support and pushed the price upwards, but then buyers managed to push it downwards. So it's right there, and it's at 29, around about 29.52, and so this is not really a good price to buy at the moment. You want to wait till it comes back down to the 25 level, and then it should move upwards. And then when you have far more experience, you can just use a retracement of this at a specific point, looking at some other indicators as well. So this is how we draw support and resistance lines and we analyze the charts. Now I'm going to be putting up a number of other examples for this. I'm going to run you through some charts, etc. And the more practice you get, it's going to get much easier. But this is the basis, the very basic information for technical analysis, and if you can master this, this is the key to success. There is nothing else. This is the most important thing. Everything else that you're going to learn is going to be built upon this, because support and resistance works with indicators, it works on strategies, it works with individual candlesticks, it works on Fibonacci's, it works on so this is basically what I'm trying to say, is that you need to master this. If you can do this, everything else is a piece of cake. Now I urge you to put your questions into the comment section. I will try to reply as soon as I can, and if you have any problems, you can even you can put up some charts as well, and I'll take a look and I'll tell you where you're going wrong. So let's take another chart and make another couple of support and resistance lines. We choose the technical interactive charts. maximize the window, choose candlesticks, get rid of the volumes, move back, and see what's happening here. So we notice that at this level, buyers stepped in, making the price go upwards, buyers stepping in again. So it's fair to say that we can draw a support line like that. We also notice that sellers moved in at this level again right there and again right there, which is roughly the same. So we can draw a resistance level. Prices move upwards to the resistance level and they shoot back downwards all the way. So what happened here? Sellers had some major selling all the way, pushed the prices all the way down to almost $34 a share, but then buyers moved in and pushed the prices upwards. So maybe there's a resistance level somewhere around here. In order to look whether this was indeed a support level, we need to look back into the previous part of the chart. And so we zoom out and let's try to place a support line right about here. Now moving backwards, what we see is that buyers stepped in at around about this level. Prices were shot up to 40. Resistance was reached. Sellers stepped in, pushed the prices back downwards. Prices stalled. The downward momentum was stalled. Prices tried to rise, but the sellers managed to temporarily push the prices downwards even further. Therefore, this line and this level here corresponds. So it's fair to say that a level around about at 34.97 is also a support level. So basically what happened was that when sellers came into the market, they came in with such force that they broke the support level at around about 40.62 and prices shot further down. However, the new set of buyers who were sitting at this level started to buy, the selling pressure faded, and the price started to move upwards. It moved upwards so much that it went past our resistance level. So any kind of purchasing at this level or even at this level would have resulted in very good profit, around about $8 per share. So in this lecture, we're going to go over support and resistance one more time. However, we're going to draw our support and resistance way back and see how they come in handy later on. So I've selected a chart here and let's go to our interactive charts. We're going to maximize, choose candlesticks, get rid of the volumes, and now let's just move back. Okay, so we see here that sellers came into the market at 1, 2 in these 3 points and prices started to fall. So we can pretty quickly draw a resistance line at this level. We can also draw a support line here. Since we see that buyers came in, prices were going towards the support, buyers came in, pushed the prices upwards to our resistance, and the resistance was broken. Now while we're at it, let's try to take a screenshot. If you have Dropbox installed on your computer, you can just press the print screen button and a screenshot will be taken. You click on this, it'll open up the screenshot, and you could just forward this or post this onto our Q&A section, or you could send it to me and ask a couple of questions. Now let's move forward into this chart and see what's happening. So we have this region where prices are starting to move down and bounce off a support here. We can zoom in and see. Let's move forward. So prices bounced off again and they started to fall. So we have these two regions. We could draw a resistance line right there, and so we see a doji, almost a doji, appearing towards the resistance line. We see a hammer, inverted hammer, towards the resistance line, which is indicating that the price should reverse and move downwards. We see a spinning top right there, and so prices temporarily break above the resistance line but then start to fall, and they go down to our support level, shoot back up to the resistance, and now they're falling again. If this line fails to be the support and turns into a resistance, we would expect the prices to drop down further to our next level of support. And there we see it. Even though this level of support was made way earlier on, so let's move back. See, it is still valid at this point here. If we would get into the trade and buy around about 27.48, we could have exit the market at 30. So what do we see here? Prices shooting all the way up and trying to fall from this region. So we have a resistance at this level. Let's draw that. Again, price reached the resistance level and fell down, went up, broke it temporarily and shot back down. When prices fell dramatically, buyers stepped in and pushed the price upwards to close in the positive. So we see again here that our support at 30 is pretty strong. Push the prices way up again. The important point to understand, to take out from this, is that we always want to buy at a support level. Let's say prices are rising and you tend to purchase in this region or maybe at that region. That would be a very risky move since prices could just fall. And here we come to the end of the chart. So in the previous videos, we've been going over how to apply support and resistance lines, and we've applied them, by means of a few examples. Now, what I want to do in this video is I want to bring an interesting fact to you. So support and resistance is where buyers and sellers are coming in, and what we need to do is we need to move back into our chart and see where exactly this level is being applied, and then we want to verify it. We want to check whether it's valid or not, etc. Now there's an easier way of doing this, and this is a trick. Basically, once you've done support and resistance lines, you place them on your charts, you'll find that some of the even numbers on your chart are very easy to remember, and these are naturally, almost always they are valid support and resistance lines. So here's what I want to do. I want to look at this, right? So we see that buyers and sellers they were pushing prices upwards, and then sellers took control. They pushed the price downwards again. Around about this level, it started to come down, and then again over here. So I'm going to go into this line here, and we'll place something over here. Let's make that bolder and black in color. Now the line that we placed is at 194.77. so what I want to do is I just want to show you something here. Let's go into coordinates, and then we'll change that to 200 and press enter. So now what I'm going to do is I'm going to take another line and I'm going to place it at 190, and then let's place another line at 180, and we'll do another one. We'll do another at, let's just go with 170, and then we'll say 210. We'll go with 160, and then let's go with one more, and this is going to be at 150. So now let's just try to analyze the chart. Okay, so I just want you to go through this and see what's happening. So basically prices were going down, and then we see the prices go up, and then at this around about 150 level there is resistance, right? So it won't let the price go up any further. It just came back down and then went up and came back down, and then eventually buyers just pushed the prices so far up, it just opened right there. So this is a very valid level of resistance moving upwards. So we have another level of resistance right here. Prices started to move down. This is the valid level of support at 160. They go up, they come back down, they bounce off the 160 support at 160, they come up, and then they just open above the resistance and go upwards. They come to 180, and then there is some resistance, not too much though, but price comes down and then moves upwards, and then it goes all the way up there, and when it comes back down, so this is acting, this resistance is now becoming sort of like support and is pushing prices upwards, comes back down. Now when it comes down to this again, so this was the previous resistance, and now it's going to act as support, and it pushes price upwards, comes back down, gets pushed upwards. Then it opens below, moves all the way down the very next day, and then jumps back upwards. So basically what I'm trying to say is that usually traders remember even numbers such as 150, 160, 100 or 200, 300, 50, and you could just even go in increments of 5, and you'll see that these are very valid levels of support and resistance. You don't need to go and look for each one of these by the previous methods. They are actually the way that this actually came about, and for many years people just used actual levels that used to verify, used to go back, they used to see how many times is this happening before. So you don't need to really do that. You could just place in the lines and then move backwards into your chart and see whether they are valid or not, and you'll find that in most cases they are valid. So this is an easy and it's a good trick to master support and resistance lines. So let's just move a little further and see what happens. So now we're above the support line right there. We want price to move upwards before we would sell out, and look at that. So price goes, it breaks above the 202, and you would expect price to come back downwards right there, and then bounce off that support and go upwards, and then you could also come and test it just like that. It came back down. So there are a number of ways in which you could trade the support and resistance, but the one that I've explained in this course is that you want to buy at the support level, or when something just bounces back to the support level, and you want to sell out when price comes to the resistance level. Now this is not the only way that you could trade support and resistance. If you'd like to know the other ways, then you could just send me a message in the comment section, ask me a question, and I will try to reply, and I will try to post some videos where I could explain this in another course, right? So I look forward to hearing from all of you. Try to use this, and this is valid for all kinds of stocks on all kinds of charts. Obviously, if the stock is trading at, let's say if it's like a penny stock, it's just trading $1.2 or $3, then you wouldn't be applying support and resistance lines at the increment of $10. You'd be doing it at every 25 cents or maybe every 50 cents. It really depends, but I'm giving you the gist. I'm not trying to cook the entire pie for you. I want you to be able to go through these charts, look at them, try to develop something on your own, and whenever you get stuck, just send me a message and I will try to help out. Now I teach students how to trade using simple candlesticks, trade via indicators, and trade strategies. But my students have not only taken courses from me, they've learned from other instructors as well, and picked up some things from YouTube along the way. Now most of my students still come back and ask the question, how do they become successful at trading? And this is not only an important question, but it's also the most frequent question that I'm asked. Now, I see that a lot of beginners make some fundamental errors. Now, these errors are not only for beginners, even experienced traders make this error, and they end up blowing up their account and destroying their trading careers. So in this video, I'm going to explain to you how to become a successful trader and what are the main qualities of a successful trader. So the very first step is to identify and quantify what exactly is success. Now, I'm not referring to the dictionary meaning of success. I'm saying that each individual needs to identify what they mean by success. So let's try to understand this by means of a hypothetical example. So, we're going to assume that you start out a business with $10,000. And we're going to take an example of two individuals, right? So there are going to be two examples here. Now, both of these individuals who have $10,000, they both decide to start a flower shop business. Now, you also expect that there are going to be overhead expenses, salaries, rental expenses, purchasing expenses, etc. And then we also expect to make a certain kind of profit. Now, let's assume that you sell a basket of flowers for $25. The entire costs are $20, so you make a profit of $5 on every sale. Now, if you assume again, or you expect that there are going to be two sales every day, that means that you're going to make a profit of $10, and with 25 working days that makes a total monthly profit of $250, and you multiply that by 12 and you're going to get $3,000 in profit per year. This means that you make 30% profit on your investment of $10,000. So this is the first example. This is what person A ends up doing. He makes certain expectations and then he jumps into his business. He says that 30% is going to be my profit. On the other hand, we have another person B, and he says that he expects to make $50 in profit. So he still has the same cost of, let's say, $20 a basket, but he's making a profit of $50. That means he's trying to sell it for $70 per sale. And then he also says that no, I'm not going to sell two baskets a day. I think I'm going to sell 20. But he's only putting up the same $10,000. Both of them have the same amount of money. So basically, person 2 is expecting to make a profit of $1,000 per day, and with 25 working days, that is $25,000 per month and $300,000 profit per year. Now this means that person B is expecting to get 300% profit on his investment of $10,000. Now, if you think about it, is that really possible? I mean, it's very improbable. I think that he's expecting too much, and if he fails to achieve that, he's going to say, I'm not successful. So basically what I'm trying to tell you is that you need to set realistic goals for any kind of business anywhere in the world. So you're starting out with $10,000. What is your expectation? What is your goal? If you were to set your goal at $300,000 as opposed to $3,000, there's a huge difference there. And this is the fundamental mistake that every trader ends up making. You think that you're going to start out with $10,000 and end up with $300,000 at the end of the year. That's an unrealistic goal. That is completely unrealistic. It's not going to happen. It may happen for 1 out of a million or 1 out of every 10 million. It's like, winning the jackpot lottery. And that's the plain truth that I'm trying to tell you. I don't want to sell you a dream, but you need to make very realistic goals in order to see whether you're actually succeeding at them or not. Therefore, I want to ask you this question. What kind of return are you expecting from your trading activities, and what kind of investment are you going to put up? And then try to see whether it is achievable or not. Now, this is not a get-rich-quick scheme. Traders who are successful in the long run have been putting in a lot of hard work, and they have realistic and achievable goals. Next up, we're going to discuss another problem that typically every trader goes through. So moving forward, we're going to assume that you sell a basket for $25, and every time you sell that basket, you make a $5 profit. Now, a customer walks in and he's walking in 3 days in a row and he buys that $25 basket of flowers, and every day you make $5 off him. So you're expecting that on the fourth day he's going to walk in as well and he's going to buy it. And he's been buying it so long, every day he's just coming in. It doesn't really, the $25 isn't too much for him. That's why he's coming in. So you decide to increase the price and you say that I'm going to charge him $27 on the fourth day. Now he might go ahead and still buy it from you, but what if you had asked him for $45 on that fourth day? So the chances are that he's probably going to run away. You'll lose that customer, and you'll also lose the $5 that you could have earned on that fourth day as well. So how does this relate to trading activities? Basically, what happens is that you get into a trade, you believe that you're going to be making, let's say, $5 or $10 or maybe $1,000 on that trade when you get into the trade. And then later on you see that, okay, the profit level has already gone up to $900. Let's assume that you were choosing $1,000 in profit and you're up to 900 and you're thinking, okay, so it might go up even a little bit further. Let's just increase. We'll get out of this trade at let's say 1200, and then price goes up to around about 1050 and you're saying, oh no, I think it's gonna go up to 1500. And by the time it even goes up to $1,200, and then it just goes in the opposite direction, and now you're not even making the $1,000 profit that you could have walked away with. And you could do this so many times, and then suddenly market situations change, the technicals are saying something completely different, and price goes way down. And instead of making any kind of profit, you're making a loss. So basically, successful traders do not keep changing their profit levels. When you get into a trade, you need to know where you're going to get out, and then you need to stick to it. You cannot be changing your goals, and we cannot change our profit margins every time we think that a trade is going in our favor. So basically, you need strong discipline. And when people they are unable to control their emotions, that's where they end up making huge mistakes and they blow up their accounts. So you need to do this. You need to control your emotions. Now, unfortunately, controlling your emotions is not something that can be taught very easily through a course. It comes with practice, it comes with experience. But I want to put this in so that you understand that controlling your emotions is a very, very important part of trading. If you can do this first step, then yes, you can be very successful. You can make tons of money. The second step is that you need to be able to manage your trade sizes. So this is basically called trade size management, and we will get into this in some of the later courses. So I hope that you enjoyed this video. If you did, please go ahead and give it a thumbs up and subscribe to this channel. Congratulations, you have made it through this basic technical analysis course. We have studied Japanese candlesticks. We've seen how to read them, create them, understand them. We've identified some of the basic kinds of candlesticks on our charts. We've learned how to read these charts. We know what support and resistance lines are now. We can draw them. We can draw trend lines. And we can combine our knowledge of support and resistance and trend lines to get a much better idea of what prices are about to do. However, you need to remember to keep practicing these skills. The more practice you get, the better you will be. So now that our basic technical analysis course is over, Let's see what else is out there. Traders typically use indicators on their charts as well. There are many kinds of indicators, and indicators are tools that can give us a sense of direction or confirmation of movement in prices. So there are the most basic kinds of indicators are the moving average lines, the Bollinger Bands, the relative strength index, the MACD. Let's take a look. These are the moving average lines which could be added from the indicators section here. There are many kinds of moving averages, and we look at the crosses, the moving average crossovers as well, to determine where prices are going to be going. We could use the Bollinger Bands, which show us the amount of volatility that is happening currently in the market. We can use the relative strength index, the MACD, which is the moving average convergence divergence, or we could also go ahead and use some of the Fibonacci sequence tools. In this case, this is the Fibonacci retracement tool. Once you are aware of all the indicators and how to properly use them to generate consistent profits, you can use these indicators to develop trading strategies or just master some of the strategies that are already out there. Now, understanding these strategies is usually the difficult part. In my future courses, I will be discussing all of these indicators one by one, as well as giving you specific, easy to understand trading strategies that can time and again generate profits. So I hope that you will continue your learning, and if you have any further questions, please feel free to ask.